Welcome to our session on the exponential growth sector of fintech. I want to introduce our two speakers who are going to be joining us for this panel discussion. Nasser Chanda is the CEO of Paymerang, a fast-growing fintech unicorn based in Richmond, Virginia that specializes in best-in-class finance automation utilizing artificial intelligence. Nasser oversees the strategy and direction of the company, which is backed by $36 million in privately funded financing. He has more than 20 years of experience in startups and payment companies, including launching and growing Brink's Global Payments, which became a profitable business with over $100 million in revenue and operations in 5 countries under his leadership. Nasser began his career in investment banking at PricewaterhouseCoopers and led global strategy and M&A at the Brink's Company. Andrew Ting is an adjunct professor at Georgetown University's McDonough School of Business. He has served as general counsel for financial services companies, technology companies, and venture capital funds, including West Creek Financial, which recently has been renamed, I hope I pronounced this right, Koalafi.
Some qualified
Koala Finance, is that good?
Yep.
Okay. And Andrew also has worked at Spring Arbor Financial Group, Promontory Mortgage Path, and Canopy, maybe it's Canopy.
Venture, just the Fintech VC fund. Thank you.
And Andrew also is a professorial lecturer in law at George Washington University Law School. Please welcome our two speakers, Nasser Chanda and Andrew Ting. Okay, I'm going to try to look up so that I'm talking to everyone. We want to talk about fintech, and for people my age, we think about Flipper wearing some thick glasses, but financial technology is literally, I'm not going to say it's taking over the banking industry, but it is taking it to a new level of decentralization, and bringing just about everything you can think of into the digital domain. So I'd like to get us started by asking both of you to tell us what the most transformative applications are that have entered the marketplace, whether it's digital payment startups, blockchain-driven applications, artificial intelligence, which Paymerang is involved in. How quickly do you think we're going to realize the potential of fintech, and where do you think it's going? Nasser, please start us off.
Sure. Hi, everyone. I think that it's the methodology that really is the killer app in terms of transformation. So I would say, things like Stripe, which is a very best-of-breed application in merchant acquiring, but then it has lots of developer tools, lots of APIs to plug tons of things into it. And then the accounting space, QuickBooks Online is the same kind of thing. It's a great little ERP, and it knows it can't be everything to everyone, so it has lots of open APIs, well-documented, best-of-breed APIs to be able to connect into tons and tons of tools and applications. It just opens the world. You put in a Stripe or a QuickBooks Online, boom, you're up and running, and you have flexibility over the next 10 years to keep adding things to it. You're up and running fast, and you have lots of scalability into lots of features and functions. So I think that's, and then then you bring technologies with products with AI in them, or machine learning and whatever into those ecosystems, and it's pretty powerful, and the choice is great. I think the choices to consumers, choices to businesses and governments, I think is just broader. And I don't think we're talking about it as a taking away from the banks. I think it's augmentative and it's very collaborative, in my opinion.
Do you think that, I mean, the major existing financial institutions are already entering this space? Do you see them sort of subsuming all the startups? Will it be more of a live and let live, or are we going to see sort of emerging and partnerships? Andrew, why don't you take a shot at that?
Yeah, absolutely. So I've teamed up an app for working for companies with names that are difficult to say, Koalafi, Canopy. But when I was the general counsel of Canopy Ventures, it's a fintech venture capital fund, and the investors were actually big banks. So you wonder, well, why are big banks interested in fintech? And it's, well, if you can't beat them, buy them, right? Or you hire these investment professionals who scour the market, exactly as Nasser talks about, looking for the most transformative app, and say, look, this is going to take off. I want a strategic partnership with the next Stripe, the next payment processor, whatever it is, so that I can have a competitive edge against other banks, and offer something for my customers, a better experience, access to more resources, financing, et cetera, which really works. So I think it's a thriving ecosystem, and while a lot of fintechs have kind of a pirate mentality, say, hey, we're disruptors, we can do things bigger, better, faster, much more efficiently, et cetera. It's kind of true, but in the end, all roads eventually lead to Wall Street. So I think there will be a partnership. But also, it's great to see all the innovation. And to answer your earlier question about, expanding on what Nasser said about the most exciting fintech apps, I think fintech apps for us are like lending and artificial intelligence. So Koalafi, we have a network of 8,000 retail stores across the U.S. and online channels. You walk into a store, you want to buy a mattress, you don't have the money, or you have the money but you don't want to pay right now. You pull out your phone, you do our quick app, you're done in maybe 2 minutes. We use artificial intelligence and other data to make sure that you get the best product for your profile, and boom, you're done. The merchant doesn't have to worry about turning away a customer who doesn't have money to buy something now. So lots of different applications of fintech that will help empower consumers, Nasser said.
I'd like to ask both of you to please take, if you could do this briefly, just take a couple of minutes. Nasser, tell us about Paymerang's automation products using artificial intelligence.
Sure. What we do is we help automate the finance department's functions. And our goal isn't to take away jobs. Our goal is to create efficiency and security and productivity for our clients so they can be more strategic and more valuable to their organizations. The finance team can be strategic, and they can help these hospitals that we serve, or the educational institutions, or the manufacturers that we serve to be more effective. So our solution, it takes the accounts payable function from the receiving of an invoice to approval to posting to the general ledger, payment to the vendor, and we automate all of that. And the way we do that is the invoices that are received by an organization now are electronic because we enable that. They come into a queue that we have in our SaaS-based application. Then the artificial intelligence machine learning reads the invoice, populates the fields for the vendor, the amount, the due date, etc., and then routes it for approval electronically across the organization based on rules, and then it posts it automatically to the general ledger without ever touching any paper, just with clicks of buttons. And then the software then comes in and says, okay, are there duplicate invoices? Is there fraud here? Is there something strange going on with these invoices? Because the software can really analyze this a lot more, with a lot more data. The next part then is we automate the payment process. And so companies want to pay the vendors electronically. Historically, they were paying by checks. So what they do is they upload a payment file to our SaaS-based solution. They fund the batch, and they're done. We enroll their vendors, we pay their vendors, we follow up the payments, and do reconciliations on the bank accounts all for them. And that has some special rules and workflows as well in terms of optimizing the payment methodology for the vendor. And so all of that, what it does is takes away routine tasks from the finance team so they can focus on higher order activities that add value to the organization.
Just a quick question based on what you just said. The artificial intelligence program is only as good as the algorithm you create to have it function. Is that something you have to constantly update? Are you constantly expanding the data inputs to refine it and really put it in sync with what the program is actually doing?
Yeah, we teach it to be a learner, lifelong learner itself. And what it does is it keeps taking data, and as it keeps taking data, its algorithms improve over time. So it's built into the AI. And we obviously want to get as much data, you want millions of instances of data so it can be even better at its pattern recognition.
You mentioned, one other question, you mentioned machine learning. At some point, does the program take over and educate itself and the human factor diminishes?
But it doesn't. We put controls in. There's always a human element to everything we do. And we never want the machine to take over. We want the machine to do the manual work and present it to a person who will then evaluate it and then take actions in many cases. If it's a critical item that has a consumer touching element to it. If it's basic things like reading an invoice and presenting it, so what it does is it presents what it read, but the user can override some of those fields and say, no, I think this is a better answer here. Like, it might read a date as a due date, and the user says, well, I know that this vendor gets paid 5 days later or 5 days earlier, and so I'm going to tweak that. But we always want human intervention in all of these because we are a human business. We create a lot of jobs here. That's important for us to create meaning in the world. And so software by itself doesn't differentiate. The experience of the people behind it and the entire holistic solution and the experience to the consumer is what really differentiates. And that involves human interaction.
Well, when I think of AI being involved in my banking, I'm thinking the program is going to decide very quickly, this guy is never going to balance his checking account. Let's just get rid of him. Andrew?
No, they won't get rid of you. They'll introduce new fees to get more money out.
Yeah.
It also won't let us tell bad jokes. Andrew, please tell us about Koalafi.
Yeah, absolutely. And Nasser, it's great to hear about Paymerang. I had lunch today with my accounts payable team and about manual processing, et cetera. So that's truly transformative. And Jack, thanks for setting me up to talk about Koalafi and AI and lending, right? And banks. So banks are pretty conservative by nature. And one way you can use machine learning, adjusting more data points, artificial intelligence, is actually to say we can approve more people with less risk. We can actually expand access to credit for people across America by giving them financing to buy stuff they need, furniture, mattresses, auto parts they can get to work, et cetera. And that's what Koalafi does. We have a suite of products, loans, lease to own. And if you have great credit, we have a product for you. If you have subprime credit, we have a product for you. If you don't have an established credit history, we can find a product to work for you as well. So I think because we are more innovative and we ingest a lot more data and see patterns on who can pay, who might not be able to pay right now, we can approve more people with less risk and kind of serve a population that banks don't touch. So I think fintech is a bit more democratic in that way, in that it challenges assumptions of who you can serve.
Could you give us a couple of examples of data points that, the banks would tell you that's the end of the conversation, but that your program somehow gleans a different picture of creditworthiness?
Mm-hmm. Sure. Let's say that you have a FICO score, a fair credit score of 640, right? That's considered subprime. The banks might look at that and say, nope, Andrew is under 700. We're not going to give him a loan to for a home improvement project on his house. We would take a look at other factors. Say, okay, the credit score is one data point, but how are you doing on your other credit accounts, like your other lines of credit, et cetera? And kind of paint a more holistic picture. It's kind of difficult to talk about this in this setting, all the just 500, 600 data points to go through. But so it's not just kind of a hard cut-off decision, but it really takes into account more of the full picture of the consumer applicant as a person.
Andrew, you said the magic word, subprime. And since you're the law professor, I gotta fire this one at you.
Okay.
The last time we had a let's call it an explosive introduction of unregulated financial instruments.
Yeah.
They were called collateralized debt obligations. They were packages of really crummy mortgages, and we saw the end of the movie. It didn't end well. We almost destroyed the global financial system. Are we in sort of a similar moment right now? How urgently do we need some oversight of the new fintech products?
Yeah, so it's a good question. I don't think the threat is that great. Be interested in Nasser's point of view as well. But the CDOs, collateralized debt obligations, mortgages, trillions of dollars into Wall Street, so definitely a systemic risk with big banks taking bets. I don't think, even though Wall Street securitizes some of the fintech receivables, loans, et cetera, I don't think it's nearly that scale. And, hey, subprime people are people too. They deserve access to credit, mortgages, loans, leases, all that. I think it's perfectly appropriate to have robust consumer oversight to make sure they understand the terms of financing they're signing up for and that they can be paid. But I think you can't expand access to credit without also having some risk in the system, right? But I would say that, hey, responsible expansion of access to credit to let people buy what they need, especially in a pandemic economy, is very important.
Well,
and a good public policy goal.
You mentioned the pandemic, and I hate to make a pandemic analogy, but the creation of vaccines, the vaccines that work they use part of the live virus. In the UK, they've created something they call a regulatory sandbox, which I think is a very interesting term. It allows for the testing of products, fintech products, in a live market economy. Do you think that approach is a safe way to introduce these products to the marketplace? And Nasser, I'd also like to hear your opinion. Andrew, go first.
Yeah, sure, absolutely. Is there anybody from North Carolina in the room? Curious?
Yes, there is.
All right. Well, congratulations to North Carolina. On October 15th, you became, I believe, the 10th state to enact the state regulatory sandbox law, which allows for reciprocity with other states which have regulatory sandboxes. So go North Carolina, joining the usual suspects of innovative states. I'm a lawyer by trade. I oversee compliance teams. So, it's difficult in the United States. We have 50 states and D.C. Complying with the laws of each state plus the federal government is a difficult task. For example, getting licenses for each state is a very difficult task. And I think, earlier we were talking about having a federal government charter, like one ring to rule them all, to use the Lord of the Rings analogy, I'm wearing my wedding ring. That could be a little bit easier. I think if state regulatory sandboxes can take away some of the fear that we might break some state consumer protection laws, so this is a new product, the laws that are old, like 20, 30 years old, they're not built for fintech, we don't want somebody coming after us, that gives some assurances. That being said, I think the North Carolina approach and other states of having reciprocity like other innovative states is important. But hopefully the federal government should step in at some point. Because as a lawyer, I could tell my fintech CEOs that, hey, we have a great new business model, awesome. We can help people, awesome. Is it illegal? Well, I could say, well, it's not prohibited, because the law didn't even think this was possible, right? And while it's not prohibited, it still makes you a little bit queasy. So it's nice to have a sandbox to say, okay, and we can play it, test it out, and have a limit on the time, and we can apply for the necessary licenses, approvals, whatever, once we understand exactly what we're building and the consumer impact.
The oversight, would you like to see, and I guess I'm talking primarily about federal oversight, and what type of oversight do you think we're going to see?
Sure. I kind of like the idea around the OCC's special purpose bank charter in terms of a national charter that prevents or does it require all of these companies to have to go to states to get the money transmitter licenses and things like that? I think a national charter would be good for that. At the same time, I will say something. Fintechs typically work with the rails of banks and MasterCard, Visa, and others. So for example, we have for benefit of accounts with banks, and we also have, we use a national network. We use Visa rails. So even Stripe and PayPal, they use Visa rails and bank rails. So we're kind of joined at the hip. So that's from a CEO perspective, this is a different game here. This is, we're working with innovative solutions within established frameworks of regulated companies that are partners of ours. So I think the risk is lower there, just to answer your previous question. Vice versa as well, in that banks use us as a white label solution that they can then offer to their clients to make them more competitive against their competition. And so we make banks stronger as well. And so the sandbox concept, I think, is great. I think from a regulatory perspective, I think centralized is better than having each state have its own set of standards. And so we welcome that, but I don't think this is a runaway train like the CDO collapse.
Well, you mentioned, you mentioned the OCC special purpose national bank charter that's been proposed. That's already being challenged in federal courts by New York State. I think it's at the appeals court level. Do you think that's going to survive the legal challenge?
I probably should chime in as the lawyer. And it's hard to say. I mean, in the U.S., we have a system of federalism, right? That 50 flowers bloom, and states' rights versus federal rights and such. Everybody, I think, wants to get to the right place, but they're not sure exactly how. I personally agree with Nasser. I think that a federal charter would be important. New York is pretty aggressive in cybersecurity and in finance, et cetera. And I think it's a shame that they're challenging it. Whether it will actually go all the way or not, I think probably the concept will be tweaked so that more states can agree. Because uncertainty is actually really bad for innovation.
All right, I'm going to throw out a counterpoint to what you, I think both of you have been saying, but especially Andrew. Do you really think we can have 50 different versions of how we regulate these financial instruments? I mean, we got rid of Glass-Steagall, and that didn't work too well.
So when we roll out a new product, for example, a new financing product, I have to go ask one of the lawyers on my staff, go do a 50-state survey, please. And so he looks at the laws of each of the states, cross-checks them against the products we want. That takes weeks, right? And then once you have it, maybe there's some common denominators, but you have 20 kind of overlapping, somewhat inconsistent requirements. And you send that to an engineer and say, let's build it. You try to take a greatest common denominator approach, but it's just not very satisfying. So it's, that's the world we live in for the most part. And bank partnerships with federal bank preemption are one way to have a kind of a more uniform level field. That's how a lot of fintechs get to market. But it is a cost way to run a business. So I am in favor of more uniform standards.
Nasser, our audience today is a mix of economic development professionals from economic development organizations all over the country, state, metro, regional. We also have corporate site selectors. I'm sure a big question on everybody's mind is, does the wave of fintech startups translate into a lot of new jobs in the financial services sector? And in particular, if locations do a really good job of attracting fintech startups and creating a hub, does this also translate into new jobs? And what I'm thinking of is what's transpired with the expansion of data centers in the United States. These are big ticket projects. Every other week, going to be an $800 million data center for Google or Facebook, but it's only a handful of jobs. I mean, these are server farms. Nasser, what is your perspective on it?
We've created about 150 jobs in the last couple of years. We've had 4 office expansions. We've promoted about 100 people, some of them into 2 or 3 different roles over the last few years as well, because of what we create in terms of efficiency for our clients. And at the same time, our clients haven't laid off any of their team. What we're doing is trying to build productivity for the entire American economy. In that sense, we have created jobs and helped our clients to be more competitive. And I think that this is possible anywhere. I don't think it's San Francisco or New York. I think this can happen in Kansas and Illinois and other places. And I think it is happening. We're in Richmond, Virginia, and we've been creating these jobs. So I think, yes, you can create good ecosystems. And the other part is we've had some of those people that were promoted here and grew here over the last couple of years have moved on. And we celebrated the fact that they took on bigger roles with large companies and other companies alike. And there's an ecosystem building here. So I think if you invest with that intent and you try to help people be successful and you recruit from the schools and you build connections with communities, it does create jobs and expansion of the economy. And so, our expansion, we've had 4 expansions here in our office. We were lucky to have a building where there was room to grow.
Well, let's talk about the type of jobs that are being created and the workforce availability, for lack of a better term. I mean, aren't the new jobs associated with fintech primarily data-centric, computer science? You're shaking your head already. Okay, what are they?
We wanted a business that could scale, and there's a human experience to it. So we have, our development shop has grown significantly, but also our inside sales. We've brought in some students out of schools, and they've now spent a couple of years on the phone selling, and now they're becoming proficient to be able to be account executives and VPs. And then our operations team that serves vendors. We pay over 600,000 vendors, and we need to call them and talk to them all day long. Serve our clients. We have hundreds of clients across the country, and we have to work with our clients. So they're well-paying jobs. They're growing people and skills. They're taking developers and turning them into experienced developers with skills in cloud and AWS and Azure. It's across the board. It's not a data center. It's really a services and software business that needs a lot of great people.
So it wouldn't be correct for me to say that you're competing for the same kind of skilled workers that, say, the cybersecurity sector is competing for. And
some of them are. Yeah, some of them are, but that's not the only thing.
Because we know there's a huge national shortage. There are about 500,000 cybersecurity jobs that just aren't being filled. And I'll ask both of you this question. What can the locations, these economic development organization representatives here represent locations, what can they do and what do they need to attract fintech startups and to create a thriving, let's call it a fintech ecosystem?
Oh, sure. So since I teach entrepreneurship and at George Washington University and Georgetown University, I was asked kind of to be an informal advisor to Washington, D.C.'s Golden Triangle Business Improvement District to create an innovation hub. And so you do it a couple of different ways. Having universities in the area is nice because you have a pipeline of educated people who are graduating and looking for a job. Hopefully they like to continue to live in the area. That's a natural place to start. So partnering with career services programs to actually show them that, hey, there are tech jobs in the area, financial services jobs in the area. You like it here, right? And there are cool places to live. I think those all help to help people stay. What's interesting is the rise of remote working, and particularly in tech hiring, people don't necessarily need to be together in the same office to work. And you can sometimes get deeper talent pools from people who live in Boise, Idaho, who might work in Richmond, Virginia or such. For example, I had dinner last night with a friend of mine who works at Google. And she should be in Mountain View, but she's in Richmond, Virginia, because that's where her family is. That's where she wants to be, and that's okay right now in Google. That being said, I think there's creativity and innovation from having people together, and I think that's something that cities and other neighborhoods can provide. And so having that ecosystem of cool place to live, intellectual stimulation, maybe some government support, I think is all helpful. For example, living in Washington, D.C., last week I drove past probably the most famous site selection in the last 5 years, HQ2, and I looked at the Amazon HQ2 campus. I saw that going up, and it's huge. And we started talking about the tax issues for subsidizing it, but that's a whole other kettle of fish.
Nasser, what are your thoughts on
Well, I'll go the first one, because Andrew opened up a whole box of Pandora's box, the whole, what's the future of the workforce? And we're getting pretty opinionated on that with what we're seeing. This concept of 100% remote, I don't think is going to happen over the long term.
I'm sorry, what was that concept?
The concept of having your workforce 100% remote, I don't think that's going to work for many companies. I think there are some people who can work effectively at home 100%, but there are many who cannot. And I think that the collaboration gets missed. I think those collisions, as they call them in the office, where someone says, here, I'm struggling with this. Well, have you tried this? And that doesn't happen on Zoom. That doesn't happen in emails and Teams messages. So I think the future of the work, hybrid probably is a better way to go, but I think that if employers think they're going to go 100% remote and wake up 5 years from now with a very connected, engaged workforce, I think that's a wrong assumption. I think you'll actually have the opposite. You'll have people who are disconnected from you. You're actually just a number to them. They don't feel connected to their coworker. They don't feel emotionally connected to the mission of the company. And so I think having locations for companies to work together collaboratively is very important. As Andrew's saying, maybe it's in neighborhoods, maybe there's other ways to do that. What can they do? I think that we've had some good collaboration here with economic development locally when we did our expansions. I think they need to stay open to what's happening in the neighborhood and reach out first and not wait for companies to reach out to them. Reach out, be proactive in talking to the companies that are making news in your space. Go visit them and look at what's going on and be creative in suggesting and connecting them together. That's one. Two, if there are incentives, then give the incentives out. Don't find ways to hold the incentives back or don't use red tape to say, okay, I got you to do what you want to do, but now you gotta jump through hoops and I don't want to give you the incentive. I think incentives have to be easy to get and easy to apply for and easy to execute on. They could be clawbacks, but at least get the money up. But be approachable is my main point.
Well, okay, I want to ask one more question, Nasser, based on what you just said, and then we'll open up the questions from the floor. When I was searching for potential speakers for this session, what struck me was how many fintech startups seem to embrace living in the virtual space. I mean, you're based in Richmond, and you're proudly growing in Richmond, but a lot of the websites I went to, there's no contact information, there's no location. You don't know really how many people are employed by them. You think, I mean, I go back to, the beginning of the .com era, and, everybody wanted a catchy name, and, where was the bricks and mortars? Do you think because of the nature of this technology, maybe it's, well, we got to play it like we're all sort of out there in virtual space? What are your thoughts on that? You shook your head.
I think we're all on the same page. I think people are social creatures, right? COVID-19, obviously everybody has to be safe, but, it's awesome just to be in a room, have lunch together, get on a whiteboard, just bounce ideas off each other. That collaboration, being in the neighborhood where of like-minded creative people, that's great. That's what environments, cities, innovative, places can actually foster. And I miss that, like when I was at home for most of last year, I miss seeing people. And I think the quality of collaboration, Nasser said, suffered. So I think the folks in the room, the audience here, kind of can take it back and say, hey, we can create an environment, our city, site, whatever, where you can have, like a safe, creative, collaborative environment, create real innovation, instead of just being with a window on Zoom.
Let me open it up here. Do we have any questions from the audience? Please speak up.
I know you're talking about fintech, but do you think that the banking world will completely move away from bricks and mortar?
The question is, do you think the banking world will completely move away from bricks and mortar?
No, I don't think so. I think it's still nice to be able to go in the bank branch and talk to a teller and get, financial advice from somebody. I don't think, maybe there'll be less branches or such, so they'll prefer you to use virtual communication because it's usually cheaper. But I think human interaction, expertise, and care will always be important.
Yeah, bank branches are like the accordion we used to call them when I was at Brinks, There's a wave of shutting down branches and then a wave of opening branches and then shutting and opening. Right now, I'm actually seeing a fair number of branches opening up around us. I think especially the local banks, they want to have connections to their communities, like the regional and the local banks. And the other thing that, just from Brinks, what I know is that cash in circulation continues to increase every single year. And in fact, cash in circulation as a percentage of GDP is increasing. And the reason that's happening is because the economy is becoming more decentralized. There's more ATMs, there's more points of retail. So even though people are using less cash, there's inventories of cash being kept in ATMs and retailers and others in a more distributed fashion to require a higher degree of cash in the economy. So I don't think branches are going away, and I don't think cash is going away, although I don't use a lot of cash.
Any other questions? Let's take a minute or two to talk about blockchain and cryptocurrency. Are we, I'm just going to throw this out from left field, has anybody considered the, I don't want to call it the environmental impact, but the use of electricity to make blockchain and to do Bitcoin mining? You put that on top of plugging all of our cars into the grid, as we'll soon be doing. Is the infrastructure ready for this, is my basic question. I'll take that as a maybe.
I'll take a crack at the waste part and turn over to Nasser. Bitcoin mining is crazy. I read somewhere that the amount of electricity used to mine for Bitcoin, you basically have to mine more to get fewer and fewer Bitcoins as it goes on, is like equivalent to the energy used by some small countries in the world, right? And that is obviously not environmentally sustainable. That being said, Bitcoin is just one kind of blockchain technology, so I wouldn't kind of tar and feather all of the blockchain distributed ledger technologies with that. So, yeah, what's your view?
I think distributed ledger is an interesting concept and it can work for a lot of things. I think that currencies without the backing and regulatory backing and governments backing it and economies and people and constitutions and rules of law underneath those currencies, I'm in the view of kind of the same camp as Warren Buffett and the others. The long term, we're going to see countries trying to clamp down on it. It's being used a lot for this ransomware and black market economy as well. So I don't know. It's going to get to a critical mass of scale where people are going to start to clamp down on it, and I think the potential will start to reduce.
Well, it's interesting that you talked about applying a constitutional framework to this, and yet the first country in the world and the first leader in the world to take a leadership position on this is President Xi of China, who has banned cryptocurrency. Yeah. Is he right?
I think so.
I think crypto is innovating really rapidly. rapidly, right? And so it presents some risks, it also presents opportunities. I think China's risk tolerance is fairly low. And I respect that, at least with respect to crypto. And I think here it's evolving.
I think a good analogy is M-Pesa in Kenya. So I don't know if people are familiar with that, but basically M-Pesa came along. It was a cellular phone technology that allowed you to transfer money using your cell phone. So in Kenya, every cell phone became a point-of-sale device. And as long as you have money in your telecom account, you can actually use it to buy and to transfer money. And by Trojan horse, it became a financial system and a bank inside Kenya accidentally. And then all of the banks across Africa said, we're never going to let this happen here. And so when things get to a certain point of critical mass, then the regulators come in. And I think that President Xi's, the first one, but I won't say he's the last one.
Well, on that note, our time has expired here. I want to thank both of you for an extremely informative and interesting discussion. Thank you for making time in your schedules to join us on short notice. I'm sure this discussion is going to continue in one form or another, and if we do this again at a future LiveX, we're going to have a lot more, let's call it empirical data to see how things work out. But congratulations on your startups and the success you've had so far. And once again, thank you for joining us. And thank everybody for this luncheon.